Good morning. This is Jamie Sumner from Seafried and Brew, Chief Analyst here, as well as Kyle Custer.
Morning, everybody.
Our Senior Analyst. And today we want to review real quick over the GDP release that came out on Friday. This is the second release for the first quarter of 2016. So as you probably heard, it came out at 0.8%. That's an improvement over the first release, or the advanced release, which was 0.5%. But a little under where the consensus was about where it was going to come in. That consensus was 0.9, so just shy of that 0.9% from the consensus. But if we could dig a little deeper into here, we can see the different contributions. And as we all know, the different formula here for GDP made up of consumer spending, investment spending, government spending, and the net of exports and imports. So we look at the different contributions of each of these sectors. Consumer contributed 1.29 percentage points to the GDP. So that's pretty important because that's a big sector that feeds into GDP, and we'll look at that in a moment. Investments actually down by 45 basis points. Government contributing 20 basis points. And then the net exports, imports, contributing a contraction of 0.21 or 21 basis points. You can see compared to the fourth quarter of 2015, we grew at a 1.4%. Consumer segment brought it down a little bit. We had a little degradation here on the investments, improvement on the government, and the net exports came down as well. So that contributing to that lower level of overall growth for the U.S. in the first quarter.
This is an interesting way and a different way to look at the contributions that Jamie had just talked about. And what I want to show you here is the change. And I also want to show you how much the consumer expenditures really is, that's really what makes the GDP. And it's really important not to forget that as we see these, all the ratios and exports, government, and investment spending, as they change, it's really the consumer is what we're watching here. More recently, the consumer expenditures are now taking up nearly 70% of the GDP calculation. So, you're thinking the consumer is going to be spending, buying the items that are being created domestically. That's what's driving our GDP. So it's important to consider that, because if you really take that out of the equation, how much does it really matter what the government and the investment areas are really spending? And those areas are actually important because that's what's going to be driving the consumer expenditures. When you have government spending on infrastructure or creating more jobs within the government, you're going to see this go up and add more. Same with investment. Now that was a point of concern this quarter because we saw the investment spending kind of decrease. It was a negative contributor this quarter. And I was looking a little deeper into that, and they actually have significantly over the last couple quarters been decreasing in large expenditures in structures and buildings. So you're talking about manufacturing plants that aren't being built, which could indicate that we are actually at a capacity level. We have all the labor we need, and we have all the capital already invested. Well, that could spell trouble in the future.
That's right. And to look at another way of looking at GDP is look at the individual sections and the growth in those different sections. So we looked at the contribution to the overall growth, but now let's take a real quick look at the individual growth in those sectors. So we look at the consumer spending, the PCE. You can see over here, overall it's a 1.9% rate there, 1.9% over the last quarter. You can see that's kind of pretty low from where we were in the fourth quarter was 2.4%, and in the third quarter of 2015 was 3%. So we've come down a lot there. We tend to come down in the first quarter of the year, so that's to be expected. We hope that this trend would continue, and that the second quarter we would see a pickup of a little more than 2% with inside there.
Now we had the last year too. Now last year we had the 1.8%, but and I think even the previous year as well A lot of people attributed that to the winter.
Yep.
We really had a rough winter. This year we didn't. So the effect should not have been there as much. It was a little better than last year.
Yeah, so but that is a driving force inside of GDP, as Kyle just went over. Almost 70% is made up inside the consumer there. Looking at the private investment, the gross private investment, it actually contracted here quarter over quarter by 2.6%. And that's a pretty significant contraction. In fact, we'd have to go all the way back to the fourth quarter of 2012 to see a contraction larger than that, where it was a negative 3.2%. However, a basic highlight here, something that might bode well for the future, is the residential spending or residential investment was up 17.1% this quarter. So that's a good number. Hopefully, we're going to see that trickle over into the PCE purchasing those durable goods, which in fact declined this quarter. And then we had the gross government spending increasing at 1.2%, but primarily that was led by the state and local governments, not by the national government. So it's something to keep an eye on there. Inflation obviously is a big topic today. Tuesday, May 31st, we come out with the inflation numbers today. Month over month, PCE up 0.3%, core PCE up 0.2%. So pretty far under where the Fed wants us to be on a year-over-year basis, where we're looking at PCE up 1.1% and the core up 1.6%. So inflation still running pretty far below the Fed's mandate of around that 2% mark.
So we have an opportunity to look a little further. If you page through that GDP report that was released last week, there's a lot of information there, and we only have a couple minutes here to get that information to you. Here's a couple points we found were of interest. The compensation. Now we're always talking about, with the last slide with inflation, we're talking about stagnant wages. Well, finally we actually saw year over year compensation according to the GDP report was up 5%. That's a pretty significant jump from what else you've been hearing from the talking heads and the flat levels of inflation. Yeah, this is neat because I think that inflation number typically can be pulled down by commodities, and of course oil prices have something that really been pushing down that inflation number. I'm sure the Fed is keeping that in mind. Jamie, you were looking at the savings rate here.
Yeah, savings rate now at a 5.7%, up from a 5.2% last quarter, as well as the previous year, the first quarter of the previous year, 2015. So we've seen individuals, they're making more money, but they're also putting those money into the savings account. So that would bode well for the future, as it gives them more of an ability to purchase products in the future.
However, now we look at the corporate profits, and this is baffling to me. Now the report is saying that corporate profits are down 5.7% year over year. Now, can you give me a blank slide here? Let's talk about the stock market. The stock market's been doing this for the last couple of years. Corporate profits have been continually, slowly decreasing, and this doesn't make sense. To me, the market just is not showing what corporate profits are showing, at least within the GDP report. So something of concern. Doesn't make sense to me. Maybe somebody else can make sense of it, but we'll definitely be reporting more on this, especially next week. We're gonna bring back the leading index and coincident index, which is always one of our favorites, the maps to look at.
All right. Well, thank you very much. Thank you everyone for listening, and we'll look forward to seeing you next week. Have a great week.
Thank you.